Dear all, welcome to my YouTube channel Agribusiness, a journey. In the series of lectures in connection to the business plan, today I will discuss about some of the concepts in the line of financial management. Financial management is more important in the context when you have enough money to be invested, then you think about whether you go for the long-term investment or for the short-term investment. Long-term investment is called as the capital budgeting and the short-term investment is called as the working capital management. Today, I will discuss with an examples both the long-term investment and the short-term investment. Hopefully, it will help you to frame a proper business plan according to your product and services taken into consideration. Let's an entrepreneur plan to invest in a logistics, and for that sake he needs an amount of 10 lakh rupees from different sources. You all know that when I am highlighting about different sources, it means the money will come either from informal sources just like your friends, relatives, moneylenders, landlords, traders. These are the informal sources, or money will come from the financial sources just like the circulation of the shares, debentures, loan, or from the venture capitalist. Let's see with an examples how the 10 lakh rupees has been arranged by the entrepreneur. Entrepreneur takes 1 lakh rupees from moneylender, 4 lakh rupees from bank, equity shares 1 lakh rupees, preferential share 2 lakh rupees, debentures 1 lakh rupees, venture capitalist 1 lakh rupees, and accordingly he gathers 10 lakh rupees for the investment purpose. It means this amount of the money is highly required by the entrepreneur. Then make the proportionate. Though it is 1 lakh rupees from the money lender, then you should understand that it is nothing but the 10% of the total requirement. From the bank, it is the 40% of the total requirement. Suppose money lender will charge 24% of the interest of the money that has been lent by them, because in India you all know that money lenders charge 2 to 3% per month. It means in year wise it is either 24% to 36%. It's so high. Bank charge tentatively 10%. Equity shares normally you know that it is around 20%. Preferential share it is around 12%. Debentures around 10%. Venture capital is around 20%. Question arises, can we add all the interest cost? We cannot do that. Why you cannot do that? Because here the weightage has been given in collection of money is different. What is weightage? It means 10% are coming from the money lenders, whereas the 40% are coming from the banks. So you cannot add it. Then we should know that what should be the weighted cost of capital, or you can say that what is the weighted average cost. Just multiply that 10% into multiply by 20% of the cost, then it is 0.024. then accordingly you can find weighted average cost of capital is 0.138, or means 13.8% of cost you have to incur if you gather 10 lakh rupees from different sources. Another question arises, whether the money are coming from the bank or whether the money will coming from the debenture. You all know that when money will coming from the banking sources or from the debentures, then an entrepreneur will take an advantage of the interest rate. Suppose the corporate interest tax, that interest tax is tax deductible. Suppose corporate income tax is 30%. It means whatever the cost has been gathered in the form of the loan or debenture, it should be multiplied by 1 into 30% means 0.3. It is 0.7, then ultimately you will find 0.007, and ultimately you find from the banking sources it is 0.020. It means if you collect the money from different sources, then ultimately you have to give 12.3% of the cost from different sources. It means if 10 lakh rupees you have gathered from different sources, then definitely you have to search an investment where the cash inflow should be more than 12.3%. It means suppose you will give 12.3% or 12 rupees, 12.3 rupees for getting the investment or getting the money, then definitely that money should be invested in those sources where the investment or the money you will get the money more than 12.3 rupees. Let's see. Suppose here at the initial time you are gathered 10 lakh rupees. So I just highlighted in the form of the minus. If there is no minus sign, then Excel sheet you just cash outflow should be highlighted in bracket. Only one thing, that thing you have to mark, that either you enter the data in minus form or make it a bracket. Suppose first year from your money logistics systems you get 2 lakh rupees, second year 2.5, third year 3.3 lakh, fourth year again 2 lakh, and fifth year you will gather 5 lakh rupees. Then definitely you will be happy. You will be happy that ultimately that is 4.5, 3 7.5, 2 9.5 plus 5 14.5 lakh rupees you have to get for the investment of the 10 lakh rupees. But in the investment, the principle is that every money should be converted into present value. Suppose that 10 lakh rupees I will not take from any other sources and invest that sources only on the minimum risk. Minimum risk means in the form of the FD. Then definitely I will get 1,48,000. Suppose here is 12.3% cost of capital. Then NPV, net present value, at the 12.3%, that is the negative one. You see, if the NPV will be calculated at 12.3%, then overall value, whatever has been highlighted, that gives a negative cash, overall cash or negative profit to the organization. Then it's a question mark. Then you should calculate the IRR. IRR means at least you will get cash inflow and the cash outflow both are equal or 0. It means whatever the cost of capital, it should not be more than 12%. Then to getting the money from 10 lakh rupees, then you have to adjust and readjust your source of money gathering in such a way by which ultimate cost of the capital will not be 12.3%, rather it will be 12%. I have highlighted the formula how to calculate the NPV and IRR. You should go through that. Another examples in this direction is that how to handle the short-term investment, or you can call that working capital management. Working capital management, in the theory you know that when current asset is deducted, or current asset minus current liabilities, is nothing but the working capital management. If the current asset is the good one, then the current liability, then it is a better working capital management. But other form of ratios also be taken into consideration to understand that whether in your organization proper working capital is there or not, or in the organizations your organization is sufficient in working capital or not, your organization is sufficient in cash in the system or not. For that sake, you should know that what is the current asset and what is current liabilities. Current asset means suppose I have 10 crore rupees in my saving account or 10 crore rupees in my home, then it is called as cash deposit. So cash deposit means quickly you can convert it into cash. Suppose I need money, directly I go to the ATM and bring the money. Though it is in your account, you can do that. It's quickly convertible. Suppose there are some investment, short-term investment means FD. Suppose you are putting some FD of 10 crore rupees in the bank. To convert the FD into cash, you need some time, maybe within a week it can be convertible. Suppose someone will take the money from you and now they like to refund you, then it can be refunded, or by your request you can be refunded within a month. Short-term loan or advances, suppose you have some collaterals of the mortgage and you go for the short-term loan and you have taken 15 crore rupees, it can be done within 1 month or 2 months. Inventory means it is work in process inventory, raw material inventory, finished good inventory, but whatever the inventory you have, that is your asset, you can convert into money according to your wish. Suppose you have given some of the expenses, preferably called as the overhead expenses, insurance, electricity, interest, you already paid. That means this year you do not pay that, you already paid that. Then all these is from cash and deposit to prepaid expenses. Whatever the things have been highlighted in the form of asset, it means it gives you cash or money within a year, that is your current asset. In the other context, what is the current liabilities? Is the account payable. It means you have taken money, you have to return back that money. Whatever the circumstances, you take the money from the supplier, you have to return back that. That is your liabilities. You have taken short-term loan, definitely you have to refund back that. That is your liabilities. You have used your credit card. Again, you have taken money from the banking sources. You have in the account you have no money. But though there are some FD are there or fixed deposit are there, against that fixed deposit you are taking money from the banking organizations, then definitely you have to return back within a very quick period. If you are taking money from the customer, definitely you have to refund that. There are some of the expenses are there. Suppose you are not giving the salary wages to your organization people, then you have to give them. These are the outstanding expenses, or in overall from account payable to outstanding expenses, it is called as the liability of the organizations. According to the current asset and the current liabilities, you should understand your working capital. And in the similar manner, if the current asset divided by the current liabilities, then it is called as the current ratio. Current asset minus current liabilities, that is the working capital management. Current asset divided by the current liabilities, that is nothing but the current ratio. Then you should know that what is quick ratio. Quick ratio is a very conservative approach. You have to settle your cash situation not within a year rather than the 6 month or the 7 month. You are very conservative in your approach how to manage your cash. Then what is the current asset? The cash deposit, quickly you can take the money. Short-term investment, quickly you can do that. Account receivable, you can quickly giving the notice and take the money. Short-term loan and the advances, you can do it in a very quick way, not in the inventory or the prepaid expenses. That is little bit of the lengthier or the longer period. So if you like to calculate the quick asset, then definitely quick asset divided by the current liabilities gives you quick ratio. Then what should be the cash ratio? Cash ratio means immediately you can convert it into cash. That is quickly within 1-2 days or 7 days or 15 days you can convert it to cash. It is very conservative approach. Then cash asset divided by current liabilities, that gives you the cash ratio. Then ultimately if you calculate it, your current ratio is 1.62. It means I have added all the amount of the asset, current asset, divided by I have added all the current liabilities, then I will find 1.62. Normally it has been observed that if the current asset is in between 1.5 to 2, it is a good cash situation in the organizations. Quick ratio, if it is greater than 1, then it is a good one. Organization have the better cash positions, or can have handle the better cash position. If the cash ratio is, it is always be preferable that cash ratio should be greater than 1 but should not be less than 0.5. Here it is the 0.46. It means whatever the cash in our hand or the FD or the fixed deposit are in the organizations, it need to be improved or increased. Otherwise, to getting the cash in a very quick time, it is very difficult for the organization to take the decisions. When you have prepared your business plan, then ultimately you should be very clear about that. Your cost of capital, whatever the money you are coming from different sources, you should be very clear that you should find the best investment options by which you can overcome your cost of capital in the long term investment. In the short term investment, you should be very clear about that, how to handle your cash position or the working capital. Then if you do that, then definitely your product and services will likely to get or increase your profit positions for your ventures, and investor will be attracted for your organizations to invest on. That's all about the series of one of the series lectures, how to handle the financial management for a sustainable business in the competitive era. Thank you all. Thank you for watching my video.